You're not a trader, you're a gambler. The reason your account is sitting at zero isn't because you don't have a secret strategy. It's because you have the risk management of a Las Vegas tourist. You see a smart money setup, you get excited and you go all in. Wrong. In this video I'm going to tell you why this way of trading is not very good for your trading account. I'm going to show you the cold hard math what the big banks used to say rich while you are losing all your money. I'm going to show you why one bad trade can lose to you all your trading account. Look at this math. If you lose 10% of your account, you need an 11% gain to get back to break even. Easy, right? But if you lose 50% of your account because you were sure about the trade, you don't need 50% back, you need 100%. You have to double your money just to get back to where you started. This is the death spiral. While you are distracted by Trump's bam effect, tweets or war headlines in the Middle East, you are making emotional bets. The market doesn't care about your feelings, it cares about your position size. The solution is 1% rule. Here is the secret. Professional traders, the smart money, we don't think about how much we can win, we only think about how much we are allowed to lose. You never ever risk more than 1% of your total balance on a single trade. If you have $1,000, you are allowed to lose only 1%. It means $10 on one deal. But that's too slow, you say. No, that's how you stay in the game. Even if you hit a streak of 10 losses in a row, which happens to the best of us, you still have 90% of your trading account. You're still a predator. The guy risking 10% for trade is already extinct. I know what you are thinking. How do I calculate position size in 5 seconds while the market is moving? You don't do it in your head. I built a professional risk calculator. It's an Excel and Google sheet where you just plug in your balance and your stop losses, and it tells you exactly how many lots to buy. I use this for every single trade. I put it in my Telegram channel for free. If you want to stop gambling and start trading like a machine, go to the pinned comment, click the link and download it right now. Don't take an trade without it. So now let's move to the real chart examples where I'm going to show you all secret strategies, how to calculate your risk management tool, how to use it in the live trading. So now let's move to the BTC trading and I'm going to show you what tools you need to use. And now here I can show you my best deals in my opinion. I read the market like a beast, very good successful trade from which you can entry and get a good risk management, and if you are risky enough you can get risk reward ratio. So now let's move to the previous movements and pick one which we can justify. So for example, for the good risk management we need a good entry point where we can place a good stop loss and good take profit, from which we enter, from which we are calculated our risk management, and from which we are calculated our stop losses. So now let's look at this situation in which we can determine our fair value gap, our trading entry point, stop loss, and take profit. So here we are going to open a short deal because we have a downtrend movement which break our upside movement here and determines attached. I don't know how to say it in English. And here we can determine our fair value gap from which we can entry a very good deal. And about how to determine a fair value gap, I told you about this in previous videos. So we need to take this tool. I think you all know how to use it. L means long position, S short positions. So we want to enter a safety deal. Now I will show you several examples for how we can enter from FVG. For example, here we want to open a short deal. We are entering from the edge of the FVG to cut our risks, not to enter a deal. And we need two moments: take profits and stop losses. This area are stop loss, these are take profit. So we need to determine our stop loss. We can place it in several ways. The pool of liquidity, for example here, here and here. But it is not a very good take stop loss in this situation because we can't get a good risk reward ratio, what we wanted to see in our trading. The risk reward ratio are showing us how much we can earn in this deal. For example, if we are risking 1% of deal, risk reward ratio 2, so we can win 2% while we are risking 1%. And the best way to enter a deal is when your risk reward ratio don't lower when free. It is a golden rule. So the another way to place a stop loss is the end of our FUG. It is one of the best ways to place the take, to place the stop loss, because if the price breaks our FUG zone, it is not more valid point of interest and point of entry. So we can place the take profit here. It is a safe way. It allows us to get a good risk profit, risk reward ratio, and risky way is to place it like that on the 50% or closer. So the lower our stop loss and highest our take profit, the risk reward correlate by these means. So we are going to place the safety, fair value gap, take profit, stop loss. And now we need to determine our take profit zone. So in this case, we are wanting to and aiming for the grabbing of liquidity, because the smart money moves only for liquidities, fair value gaps and order blocks. So it is our mastodons of our ideas. And we can see a huge fair value gap here, pool of liquidity here. And we can place the take profit here, because the price are going to grab that to get a new powerful movement, because if these positions are not going to be grabbed, the smart money don't have enough power to move in our direction. So here we get a risk reward ratio about 4. It is good, but the main question is how to calculate your size of entry. So you can use my calculated file in the Telegram channel, or you can use the trading view instrument. You just need to double click here, place your account size. Don't change these meanings, because it is only used when you are trading shares and bonds. So here we can place our risk. The golden rule is 1%, but if you are a risky trader and, for example, you has a low amount of your account size and you want to grow faster but more riskier, you can place 2%. Higher is for experienced trader, so 1 or 2%. And 2% means when the risk reward ratio is 1 to 3. If you risk by 2%, you win 6%. So the main things is account size and risks. So that's all. When we place OK, we placed our deal. And here, these instruments shows us on which quantity of cryptocurrency we need to open a deal. So if we opened a deal with leverage or no leverage, I don't know what cryptocurrency we are trading, we need to open by this quantity. But don't forget, if you have a low trading account, and if you are trading on 1 minute time frame or 5 minute time frame and use higher leverage, you can be swept by stop loss, and it wouldn't close in your meanings. It can just skip it. So here we can see what meanings so here we can see at what price we are going to set our stop loss, set our take profit, set our limit order, and wait. And the one important thing I want to mention in this video, you can and I can say you should fix your position size by size, and after you fix about 70 or 50% of your profit, you need to move your stop loss in the place where you begin the trade. So in this case, you are 100% in a profit. For example, here you fixed your 50%, 30%. Here you fixed your 50%. Here you fixed your 70%, and here 100. Yes, of course, your end profit wouldn't be so much as you expected, but it is the most safest way to save your money. Don't forget about it. And now let's move to the one example which I wanted to show you. Here we can see the FUG. A good FUG, fake break of structure here, forming a pool of liquidities from which we can place our take profit. For example, we wanted to enter here, place a stop loss like here, not risky, not safety. But if we place the take profit like that of this pool of liquidity, we will get a risk reward ratio about 1.5, and it don't satisfy us. We don't need to enter deals like that, because when you win one deal, to lose all your profit by this percent risk, you need to lose 3 deals in a row, and you will be in zero profit. You won't in minus, you know. And in my Telegram channel I'm going to drop the mathematical calculated sheet where I'm going to show you how much you need to lose and how much you need to win to get a very good profit. So the placing a good take profit and stop losses are the masterpiece. You need to practice that to determine where you want to place your stop loss, to place your take profit. For example, here you need to see the previous version of your chart, previous, to see the all data you need to use and place take profits on liquidity zones and VG zones. That's enough. You don't need other marks of entering a point. For example, here we have a risky deal because we don't have our confirmations of reversal of the price. Here we get a bad risk reward ratio and we don't enter the deal like that. So I think I showed you all what I wanted to show about the risk reward ratio. So follow my Telegram channel, from my YouTube channel, drop your likes and write comments about how to this video helped your trading account.